The money formula: budgeting, investing, valuations. Alex's journey turning a cafe idea into measurable value by evaluating future cash flows, risk, and discount rates. Meet Alex. Alex wants to start a revolutionary new cafe called the Future Brew. But before Alex can pour the first cup, they face three fundamental financial questions. How much should I budget? What is this business worth? And why should anyone invest? Here is the start. Budgeting, NPV and discounting, and risk management. Here is the blueprint. Here's the financial compass for the NPV, net present value. To find the value of the future brew, we look at all future profit projections, the cash flows, and convert them into today dollars. This is essential because money next year is not the same as money today. They are like different currencies. So you must convert those future cash flows using an appropriate exchange rate known as the discount rate. This calculation, the sum of all discounted future cash flows minus the initial investment, is the NPV. If the NPV is positive, Alex should take the project. Why? Because a positive NPV means that the project generates more value than its cost, maximizing the value for the company's owners. In other words, profit. A key rule is when calculating these cash flows, we focus on actual cash movements, not complex account earnings. We need to see the actual money in versus the money out. But where does all this important discount rate come from? This leads us to investing. Investors must be compensated for waiting and compensated for risk. The discount rate represents the expected return demanded by investors, also known as the required rate of return of cost capital. A fundamental lesson in finance is you don't get something for nothing. You must be paid to bear more risk. However, not all risk is created equal. Alex's coffee shop faces two types of risk. Idiosyncratic risk, the Irish jig. This stock-specific or project-specific risk, like a random leak in the roof or an unexpected shortage of baristas. This type of risk can be diversified away by investors by holding a large portfolio, so it is generally not rewarded. The other one is systemic risk. This is market risk, the risk you cannot get rid through diversification. If the entire economy slows down, Alex's sales suffer along with everyone else's. Investors are rewarded for bearing the systemic risk. Therefore, the discount rate used to value the future brew must be risk adjusted to reflect only the systematic risk of the project. A high risk, volatile business like Tech Cafe will require much higher discount rate than a stable utility company. If we find a positive NPV using that proper high risk adjusted discount rate, we know Alex's project is truly worthwhile. Valuation is the process of setting the price of an asset. Investing is determining the cost of a capital based on that risk. And budgeting is applying those concepts to ensure the project generates a net present value high enough to justify the risk. These concepts, from simple cash flows analysis to complex risk adjustments, are the universal language of business. By understanding this formula, Alex can turn a dream into a financially sound reality. It's like mapping a journey. You must know the distance, and you must account for the speed limits and danger to know if you can actually reach your positive destination.